Okay, here's the entire strategy that we're going to work through. First of all, the framework you're about to learn works. I trade this stuff. I have a verified MyFXBook that shows the consistency of the approach. So if you patiently watch the whole video, you'll understand the exact logic that can deliver this type of consistency. And to put it into a single paragraph, this framework is going to be about a simple strategy. It's about finding which economy is being pushed toward more hawkish conditions, which economy is being pushed towards more dovish conditions, and then trade the divergence and do it only when the chart gives us a clear entry without chasing. This, put it this way, is gonna sound boring, but it works. And boring is profitable. Plus, the best part that you're about to see is that all the heavy lifting here, the data analysis, the context analysis, all of it will be taken care by artificial intelligence. So you don't have to spend hours copying and pasting data and comments in a spreadsheet and such. It'll all be taken care by AI. Probably now it sounds overly simplistic, AI doing all the work, sure. But if you stick with me through the video, you'll have a personal and free macro framework that you can implement in your trading immediately. So to give you some structure, this video has 4 distinct parts and we're going to move through. Part 1 is building the data table. Pretty simple, okay? Getting ChatGPT to organize all the macro information properly for you. Part 2 is finding the divergence, where the extremes actually are. And to be very specific here, we're talking about macro divergence. Okay, we're not talking about technical divergences. I know most traders have been conditioned to think about divergences as the other side and whatever else. And we're talking about macro divergences here, okay? It's gonna make sense in a minute. Part 3 is turning those divergences into a watch list. A precise, specific watch list so you know which pair and which currency to focus on, and most of all, in which direction. This is what's going to bring clarity and solidity to your trading, okay? Because before you get onto the chart, you know exactly what you want to trade and in which direction you want to trade. And then part 4 is waiting for the chart trigger so you know exactly when to execute, and that's pretty straightforward, okay? Let's do it. Let's jump straight into ChatGPT. First of all, I want you to make sure that you're using ChatGPT 5.5 or whatever is the latest model by the time you watch this video. But the important part is that you're using the thinking mode. It's gonna make all the difference, okay? The instant mode is just awful in this, so make sure you are in the thinking mode. That said, most traders, when they go onto ChatGPT, when they are on this exact specific page, what they do, they start asking for, what's the best trade? Hey, should I buy the euro? Should I sell the euro? Okay, fine. It's a fine question, legit one. But it's a question so vague that it invites, especially from the AI, a vague answer. Okay, it's not going to be anything near useful. So instead, we want to ask the question that someone on a macro desk at a major bank would ask. That question is, which economies are getting stronger, but most of all are getting inflationary right now? Which economies are getting weaker and deflationary or disinflationary? Because that is ultimately what pushes central banks to move interest rates up or down. See, the whole edge here is that central banks don't randomly wake up and decide to cut interest rates or raise interest rates. They react to 2 things: inflation and labor market. When you know which economies are forcing their central banks to stay hawkish, keeping higher rates for longer, maybe hike interest rates, and which economies are instead forcing the central bank to go dovish, so cut interest rates or keep interest rates low, then you know which currencies the market is going to favor and which currency the market is not going to favor. And so that's the domino that starts the cascade for a macro trend. Because even if you know a tiny little bit of fundamental analysis, you'll know for a fact that interest rates are a major market driver and create major market trends. So the very first step is simple. We let the AI go pull and organize all the fresh macro data for us across the G10. Simple and straightforward. But here's where we separate ourselves. We don't care about data just to have data, okay? We don't care about all the economic data that comes out of a country, because that's the biggest mistake I see most traders making when they start fundamental analysis. They tend to build trackers for all sorts of data points. They start to monitor everything that comes out of a country, every single data. Well, let me tell you, that is completely useless. We care about 2 things. We care about what matters for the central bank, and that is inflation and labor market. These are the two data points that move the needle for the central bank, that says, hey, you gotta need to raise interest rates or you have to cut interest rates. Now, I've done a full video explaining in details how central banks function and what you should care about. But anyway, all of this, if you stick with me, it's going to make sense later into the video. This is where AI becomes useful, because to do all of this, to find all the context for inflation, all the context for the labor market, the central bank's target, the context for what's actually happening in the economy, what's pushing inflation, what's not pushing inflation, what's weakening the labor market, all of this, to understand and pull the context for all of this, well, years ago, it took hours, days. You have to take notes, you have to look for every single data point. You had to do a lot of work to get this done. Well, now ChatGPT can organize all of that for you in a few minutes. But this is where it gets really interesting, because all of this is going to work if you give it the right task with the right context. And you're going to see the prompt in a second. Now, all this said, I understand I'm wandering a little bit too much here, so I want to get to the juice of it. So let's get to the point. Here is the exact prompt structure that you can use, and I'm going to walk you through so that you can actually be clear about something. You can copy this structure that I'm about to show you and modify it to fit your workflow, but pay close attention to the logic, okay? The reason why this is important, because the logic is what matters. If you understand the logic, you can actually improve it, you can reward it if it makes sense for you, but listen to me closely here, okay? So here's how it goes. This is the prompt. Act as an institutional macroeconomist, pull the latest core CPI inflation in the labor market for the G10 currencies over the past 3 months, okay? This is the first step that is going to be very important. We want to understand the 3-month average. What's going on over the past 3 months in inflation and in the labor market for that economy, so that we understand, hey, inflation is actually trending up, or inflation is trending down. The labor market is weakening. The labor market is strengthening. Because central banks don't move just on a single data point. They move on the trend of it, okay? Because one data point can be volatile, and so they might tend to overlook it. So what they do is they look at the 3-month average. 3 month, okay? Inflation 3 months ago was at this, 3 months ago was at this, now it's at this. Okay, summarize which economies are strengthening, inflation up, and moving away from the central bank's target. Important. Inflation is not just inflation. Inflation is related to what? The central bank's target. How far is the central bank target? Is it moving away? Is it moving towards? Then obviously a strengthening economy means the labor market is solid. And which economies are weakening? Create a useful and simple table. And remember, the data is useful in context. I'm repeating this because it's very important. The data is useful in context with what the central bank's target are. So contextualize numbers. This is all that matters in this prompt, because we don't care just about the data because the data is important. We care about the data in relation to what the central bank was expecting. They were expecting the labor market to weaken, and maybe now it's strengthening. That's an important signal. They were expecting inflation maybe to go down. The central bank target is 2%, and maybe inflation now is 5%. Well, that's an important signal, okay? So this trend, as you can see, we're not asking it for a trade. We're asking it to organize the data. And we're asking it most of all to put things in context. That distinction right there is the difference between using AI professionally and using AI randomly. Now let's send, and while the answer actually gets generated, while the artificial intelligence goes through all of it that it needs to go through and find the central bank's data, find the latest data, find all that it needs to provide the most accurate table it can. While it does that, let me show you why this is so powerful. I want to paint a picture here, because I think once you see the concept, you start to see it everywhere, and you start to make sense of it, and you start to take trades that are very solid on this. Imagine 2 trains running. Train A is heading north, it's gaining speed, the engine is strong, inflation is sticky, the labor market is tight, central banks cannot afford to cut rates, rates are staying high. As a result, the currency is going up. Now train B is moving in the opposite direction, it's slowing down. The engine is losing power, inflation is falling, growth is softening, unemployment maybe is creeping up. The central bank, for that reason, is actively looking to either keep interest rates low or maybe even cut interest rates. As a result of that, the currency is weakening. Now, it doesn't take a genius to understand that these trains are moving in the opposite complete direction. That gap between these 2 trains, obviously these 2 economies, is what we call a macro divergence. And when you find a country and one context, hawkish context. And when you find another country in the opposite context, a dovish context, then that's when currency A versus currency B trends perfectly, because the underlying economic forces of those two countries are pulling in completely opposite directions. When this gap is widening, when every data point confirms the divergence, every weak labor market, every hard inflation from the country pushes economy A further away from economy B, pushes most of all central banks A further away from what central banks B is going to do, because that's actually the divergence. The divergence is in the central banks, in what they're going to do with their interest rates, because economy A is going to hike interest rates potentially, economy B is going to potentially cut interest rates. And so this creates a trend. The market is every time pushed by the data to further increase the divergence. At every single piece of macro data, every inflation data, every labor market data, the market further increases the divergence and so further pushes the trend up between currency A and currency B. So the simplest way that you can add fundamental analysis to your trading is exactly this: finding the macro divergence, the currency pair where economy A is heating up and economy B is cooling down. And well, years ago you had to analyze and research for hours to find these opportunities. Now it takes 4 minutes and 29 seconds with AI. Seriously, 5 minutes or so, and you have a data table that is all you need. So what can you do now with this? You look for the divergences that I've just talked to you about. You look for the extremes. This is where the actual trade idea starts to form in your head. It's where the theory becomes something that you can actually execute. If one currency has inflation that's staying sticky, strengthening, inflation reaccelerating while the labor market is not weakening, that currency has a genuine hawkish support behind it. On the flip side, if another currency has inflation that is cooling, core inflation cooled, and unemployment instead actually rising, so the labor market is cracking, you can see the actual data, okay? Inflation pretty much stable, cooling, very close to the central bank's target, which is 2%. Unemployment is actually, rising up. Well, you got a context where the central bank is going to need to be hawkish here, and a context in which the central banks will need to be dovish here, okay? Because we understand inflation and labor market. We understand the relation between that, and now the central bank sees that, and now they're going to react to that. This is your divergence right here. And I want to be very clear about what you're looking at, okay? You're not looking at good economy versus bad economy. It's not just that. Here you're looking specifically for policy pressures. Who's being pushed to stay tight and who's being pushed to actually pivot dovish? Because that is what FX cares about. That is what actually creates most market trends. Forex is relative. It's not absolute. It's economy A versus economy B. It's interest rates from currency A versus currency B. The attractiveness of currency A versus the attractiveness of currency B. What creates that attractiveness? Interest rates, the real yield, the obviously economic stability of the country. And in this table, just by looking at this table for 60 seconds, you can look at this table, you can form already some macro ideas. And now you have a candidate. Okay, for instance, Swiss franc, obviously inflation very below the central bank's or within the central bank's target band. The Swiss National Bank targets inflation between 0% and 2%, while inflation is at 0.3%. Labor market is okay, but essentially inflation is well subdued and the central bank is going to be dovish because of it. Obviously, the Canadian dollar, very dovish context because inflation is moving lower and the unemployment rate is actually moving higher. The Australian dollar was pretty hawkish since about couple of days ago. Then we got a bit of a jump in the unemployment rate that mixed things up, but inflation is very hot, well above the target band of the RBA. So now it says a little bit mixed and stagflationary because of the jump in the unemployment rate, but about a week ago this was very hawkish, and I would say it's actually still hawkish because the central bank is going to look through these jumps in the unemployment rate because inflation is still very high. And then you got, for instance, the Norwegian krone, very hawkish because inflation for Norway is very above the central bank's target, which is 2%. Inflation is 3.2%. Unemployment rate is pretty good, so strengthening hawkish versus a very dovish context in Sweden, for instance. Now, it doesn't take much long. It takes 60 seconds, seriously, to find solid divergences. What you can do here is create a simple, focused watch list. usually it's going to be 1 to 2 candidates maximum. There aren't always a lot of macro divergence going on. So you're going to find maybe 2, maybe 3 pairs where actually there's something interesting and useful. So what you're going to do here, you're going to write down, hey, the US dollar is in a hawkish context because of such and such. The Canadian dollar is in a dovish context because of such and such. So you're going to write everything down and you're going to put that watch list on. And this is where your trading becomes much calmer, much more systematic. Because now when you open a chart, you're not just opening it and asking yourself, okay, what do I think? What should I start? What's going on? What's the chart saying? No, you already know what you think. You already know the macro context. You have set up the context already that tells you need to look at this particular pair and in this particular direction. You need to look for USD CAD longs, or you need to look for NOK/SEK longs, and so on and so forth. Now this is where we go to the chart. Okay, and this is where most traders ruin the entire setup. Now I pull up here the Australian dollar against the Swiss franc because for months the context has been hawkish RBA, high inflation, strong labor market, and dovish instead Swiss National Bank because inflation very low in Switzerland and a central bank that was actually actively wanting a weaker currency to push inflation up. So let's say you build the watch list and you say, okay, the Australian dollar against the Swiss franc should be biased higher because the macro context is bullish. Okay, this is where 90% of traders mess it up because they find a clean divergence, they find a clean macro setup, they build the watch list. Okay, I want to be long Australian dollar against the Swiss franc. Look at the chart. Oh, this is bullish. Well, look at this. It's so bullish. I gotta get long now. Get in because they want to get part of the move. But this thing is stretched already. Okay, it's way too stretched. And so what happens? A normal pullback stops them out. Okay, you got long here, you got stopped out here. A normal pullback in the trend. So when you get to the chart, you're looking for one thing and one thing only: confirmation and timing. Timing that price is ready to move in the direction of the macro context. Now, this timing can be extremely simple. This technical trigger can be extremely simple. It doesn't need to be complicated. It can be a simple break of market structure. For instance, you got a trend line, break of market structure here. Obviously, there's tiny trend line here as well. Break of market structure. It can be a liquidity sweep. It can be something that I really like. It's an engulfing candle. You got a pretty decent engulfing candle here, bullish engulfing. Now, the technical, you can get creative with the technical, okay? Just do what you like. Use the technicals that you like. What you need to do is simply position when the timing says so, okay, for that macro continuation. So let me try a little bit more precise here. Here's a clean, simple way to think about what macro trigger you're actually looking for. You can use a very simple framework. It's a framework that works across any pair, any macro direction. First of all, we have identified the macro direction clearly. This example, we have established that, the RBA is hawkish, the Swiss National Bank is dovish, so this Australian dollar against the Swiss franc should continue to move higher. Now, price is pulling back a little, it's giving us a bit of a better entry in the trend, and what we do here is look on the chart and say, hey, look at this. What is this? Bullish engulfing candle. Took out the low of the previous day, closed back above the high of the previous day. It's a bullish engulfing, classic setup, one of my favorites. So this can act as a trigger. We got it straight after a pullback. So this is a great trigger to position for a continuation of the market trend. And I want to be clear about why this matters. What we're doing here with the technicals is just waiting for the chart to show that other participants are now paying attention to the macro story that we have already mapped out in the macro analysis. That is the role of technical analysis in this system. It does not explain why the move is happening. It just times the participation in the move that's already supported by the macro. I honestly cannot make it simpler than this. It's a full framework from start to finish that will deliver extremely high quality trends, trades, and setups that you can take. Now, obviously, remember that macro data changes. Okay, in this case, we got a pretty decent continuation straight from this bullish engulfing, so it worked amazingly. But remember, macro changes, data changes. Central banks change their tone if the data tells them to change their tone. So market price things, they price things out. This workflow is not something you run once, you build a watch list, and then you trade the same pair for 3 months without thinking or updating anything, okay? You have to at least every week update it. You need to rebuild the table once a week at a minimum after major CPR releases, after the labor market data, after central bank's decisions. You simply update the relevant currencies you're scoring. And if the story changes, if the macro setup flips, then you change it. In this case, obviously worked out pretty nicely because the timing was obviously specific, engulfing candle after a pullback. Instead of getting long here, you get long at a better price for the trend continuation. But what happens now? Okay, let's say the chart is actually now. Well, the story was bullish here, but maybe now the story is not bullish anymore. What do? You run the framework again. You look, okay, right now, what is the data now? What is the labor market doing in Australia now? What is inflation doing in Australia now? What is inflation doing in Switzerland? And so on and so forth. What each central banks are looking at and doing, and so on and so forth. You can do that, obviously, with artificial intelligence, as I showed you. So what I'm just trying to say here is that this is why it's important to understand the logic behind the drivers. It's important to understand the framework behind what you're doing here. So if you want to dive much deeper, we have a lot of videos, especially the hour-long video that explains everything behind why the data matters for a central bank, why the central banks act in a certain way, how you can anticipate the central banks, and so on and so forth. Now, let me bring the entire workflow together into one clear checklist that you can reference every time you do this. So, number one, ask ChatGPT to aggregate the data. You want inflation, you want the labor market, you want central banks, you want policy directions across the G10, and you want it organized in a clear table. 2, look for extremes, not tiny difference, not neutral versus neutral. Look for extremes. 3, once you find something, it's actually a good idea to verify it, okay? Double check the data is right. Do what you want to verify that things are actually properly that way. 4, it's pair strength. Again, weakness. I know I said this already, but it's very important. You gotta pair weakness against strength, okay? So hawkish versus dovish. 5, you need to go to the chart and you need to wait for the technical trigger. Okay, macro gives you direction, technicals give you entry trigger. If there's no trigger, there's no trade. Simply wait, or you look for something else. Look for a different trade. That is the practical workflow from start to finish. ChatGPT for data, data to divergence, divergence to watchlist, to verification watchlist, watchlist to chart, chart obviously then to trigger. This is why I actually like using AI for macro analysis, not because it replaces the trader, it does not, but because it removes a lot of the boring, repetitive, mind-numbing stuff that, stops most traders from actually doing the serious analysis in the first place. The work is still there, the chart work is there, the thinking is still there, but the busy work is now done by AI. The judgment is still yours. Patience is still yours. The risk is still yours. The trigger still has to be pulled by you, but you're delegating a lot of the busy work to artificial intelligence. So if this is actually useful for you, and if you want to see more videos where I break down the full process like this, instead of just talking about theory, let me know with a like on the video and a comment down below.